Are flippers the real problem in the Canadian real estate market? Let's find out. Hey there, welcome back to 𝗲𝗶𝗱 Real Estate. My name is 𝗳𝗲𝗿𝗁, real estate agent in Regina. That's my trusted assistant, Matilda. This is the weekly news recap here on 𝗲𝗶𝗱 Real Estate, where I go through the most interesting Canadian real estate related topics in the week and give you my thoughts and opinions on them. We're of course going to be talking about how much of an impact flippers have on the Canadian real estate market and a whole bunch of other exciting topics. But of course, we got to start off with another one of my terrible bad dad jokes. What do you call two monkeys that share an Amazon account? Prime mates. If you have a terrible joke that I can use in a future episode, put it in the comments below. Let's get into this week's Canadian real estate news. Starting off, let's talk about Remax's 2025 outlook on the Canadian housing market. Of course, I will be doing a 2025 predictions video. We're also going to be looking back in that video onto 2024's predictions, including my own, to see how close they were. So make sure you get subscribed so you don't miss that video. A quick little preview for what that video is going to look like. Remax back in 2023 predicted that in 2024 sales would increase, and nationally the average price will be up about 0.5%. Well, sales did increase in 2024, and with 1 month still to go in the year, the average price in Canada is actually up about 6% year over year. So we still have a little time left. We'll have to look back at that in that predictions video. But you have to remember that Canadian real estate is very hyper local. And that's why I break down individual cities in my monthly Canadian real estate market update, which you haven't watched that because you're new here. I'll put a link to that in the description and those pop-up cards. You can check out my most recent one. And nationally into 2025, Remax is predicting that sales will increase again, and the average price nationally will be up 5%. But what's going to happen in those individual cities because it is so hyper-local? Let's take a look. They're expecting that Toronto will be up 0.1%. Ottawa is going to be up 2.5%. My market, Regina, Saskatchewan, going to be up 3%. Calgary up 5%. Winnipeg up 5%. Vancouver up 7%. That one's really surprising to me. St. John's is going to be up 8%. And Edmonton and Simcoe will share the crown, being up 10%, seeing large year-over-year price increases. Now, if you want to be really brave, you can let me know in the comments below whether you think this Remax forecast is going to age well. That forecast video for 2025, that'll be coming out in January. Next, let's look at a CIBC forecast for the Canadian housing market. This is another forecast for the Canadian housing market. It's from CIBC this time, and I will put this in my 2025 predictions video. But what I wanted to specifically talk about from this article was CIBC's predictions or expectations for immigration and population growth in Canada in 2025. I'm going to read their exact line. Population growth will surprise on the upside in 2025. Remember that the government's plans are to see immigration levels and population increase decline. Through 2025 and 2026, they're actually expecting the population in Canada will decline 0.2%. I've said for a long time, though, that for that to happen, the government has to hit all of their targets, and that is a very big if. It seems CIBC also agrees with that. The government's plan is that we're going to see a decrease in the Canadian population in 2025 and 2026 by adjusting temporary workers and student visa numbers, but the CIBC disagrees with that. Specifically, there are three major points. The first one is that because we have seen a larger number of temporary workers in 2024 than what was expected, the government's going to have to get even more aggressive with their 2025 and 2026 numbers to actually get that reduction. We've also seen a large increase in asylum seeker applications in Canada, and we don't have exceptionally strong enforcement for those visas that expired, forcing people actually to leave in Canada. And that's why they think that we're not actually going to see a reduction of population in Canada, but instead a 1% increase in 2025 and 2026. The government has to go and actually hit the targets they've set, and that is a very big if. If that happens, it'll allow the housing market to hopefully catch up a little bit. But the problem we've got right now is declining housing starts. We're going to be talking about that in just a second here. So if we have a declining housing starts number and even an increasing population, even if it's relatively small, that's not a recipe for more affordable housing in Canada. Now let's get into this week's best mortgage interest rates. Starting off with insured, the best 3-year fixed was through Radius 4.44, slight increase. The best 5-year was 4.29 through Manulife, that's unchanged. The best 5-year variable adjustable rate 4.49 through Marathon, unchanged. And the best static variable is 5% through Manulife, also unchanged. On the uninsured side of things, the best 3-year fixed was 4.74 through Scotia, that's an increase. The best 5-year fixed, 4.59 through Manulife, unchanged. And the best 5-year static variable, 5.4 through Scotia, unchanged. The best adjustable, 5.45 through Strive, also unchanged. But there has been a little bit of movement in the big 5 banks. So here's the best 5-year fixed for an insurable mortgage with the big banks. Bank of Montreal moves into first place at 4.45, but they didn't change their rates at all. CIBC is at 4.59, that's an increase. Scotiabank 4.69, unchanged. RBC 4.74, unchanged. And TD ends up with the highest rates at 4.84, and that's an increase. Late last week and early into this week, we saw the bond market really shooting up, and of course, that is what drives fixed rates. It got all the way up to about 3.3%, and we did see some lenders make some adjustments early on in the week, but now that the bond market, at least at the time of recording this video, has trended back down to about 3%, some lenders have actually adjusted those rates back down. Overall though, for basically the past 4 to 5 weeks, we've seen that bond market go up from about 2.8 to 3% now, but fixed rates for the most part have remained relatively or almost entirely unchanged, which is some really unusual stability that we haven't seen in the mortgage interest rate market in Canada in quite some time. And as I always say, the lowest interest rate isn't always the best mortgage, and I've done a great explainer video as to why that is. I will put a link to that in the description below and one of those pop-up cards. Now let's go over the CMHC housing starts report for the month. Remember, this is kind of a 6-month rolling average, and these numbers tend to swing relatively wildly as projects get started. So right now the number's at 240,000, last month 233,000, but for the year it's essentially flat. We've kind of hovered around 220 to 240,000 starts all year long. Remember though that not all starts actually become completions. Remember though that a large number of these starts are purpose-built rentals being built under different incentive programs provided by the different levels of government. Most of these are not actually end user homes that you are going to actually want to buy, and even fewer are single family homes. But let's just pretend for a few minutes that all of these starts will end up as completions, and all of them are going to be actual homes that you can buy. Because remember, these are units. So a 400 square foot condo counts the same as a 10-bedroom single family home under this units number. We're not actually differentiating between single family homes, townhouses, condos, etc. But we're just going to pretend they're all actually going to be completions, something you can buy. Well, again, we're going to get, somewhere around 200, 220, maybe 230,000 starts this year. The government has promised that they're going to get 6 million homes or thereabouts built by 2030. Well, some quick napkin math says that you need to get about 900,000 starts per year for 6-7 consecutive years in order to get to that 6 million. And we're at 220, 230, 240,000 starts, trending down. Even with all of the government incentives and the big wartime effort that the government talked about to get homes built, we can't even crack 250,000 home starts in a single year. And if we do get a zero population growth for the next 2 years, again, that's still not going to get us anywhere near the numbers of homes the government has promised to get built, and the number of homes that CMHC has talked about many times over that we need to see built in Canada in order to provide some more affordability and stability in the Canadian housing market. I like to say there are very few guarantees in life, but I'm going to put this 6 million homes by 2030 in the guaranteed not to happen category. And if somehow we actually get there, I'll do an apology video to the government and everybody else saying I was wrong. Now let's talk about the big, bad, evil house flippers in the Canadian housing market. This hasn't been as much of a hot button issue as it was a couple of years ago when the market was really hot and we did see flippers in the market. They haven't entirely disappeared, but a lot of people were saying we need to get these flippers out of the market so that end users don't have to compete against those big, bad investors that are outbidding them in these multiple offer situations that were happening all over the place. So, of course, what do governments do? Well, they slap taxes on it. In the case of the federal government, they modified tax codes so that houses sold within 1 year were considered flipped. And then that became essentially a business income tax. And then they've got different provinces that have put in different measures and tax policies as well. Now, this particular article is talking about Stats Canada for BC in particular, but you can say that BC and Ontario are going to have relatively similar numbers, and they would be on the higher end of the range for number of homes that are flipped in a year compared to, say, provinces in the prairies or the Atlantic provinces. And I've said for a long time that, in my personal opinion, I don't think it is flippers that are the problem. There are many other things that are an issue, and I'm not saying that speculators aren't in the market, but that isn't the true root cause of the problem. It's a symptom of the bigger problem in Canada. Now, you can put these flippers into essentially three categories. The first is those that are purely speculating on house price appreciation. So they're buying houses, they're generally looking for these really good deals, maybe an undervalued house in a rapidly appreciating market. They're going to buy it, and they generally don't put much or any work into them, putting them back on the market in a relatively short period of time, hoping to make a quick buck. The second category is for the pre-construction market. So these are investors that will buy essentially the right to purchase a completed unit, and then they're going to flip that out closer to possession. They don't have any intention of actually closing on and occupying that unit. The hope is that they will make some money as that property has appreciated in value, be able to sell the contract of purchase and sale to somebody else, and sometimes these are sold multiple times over. And a lot of people said, we need to get these investors out of the market. But you have to take a little step back, because for most of these large downtown condo type projects, you need these investors in the market because they are the ones that are putting up the initial capital and deposits, etc., to actually help the developer secure their construction financing. Many banks will require that these developers have 50, 60, 70% of the units pre-sold before they will fund construction. And a lot of end users aren't able or willing to wait that 3, 4, 5 years it may take before that unit can be occupied. And your third category is those that have legitimate businesses where they buy typically run-down houses and they fix them up, putting them back on the market. There are a lot of buyers that either don't have the financial capacity, the cash on hand to do those renovations, or the skills to go out and do the renovations. So they're wanting to buy fixed up units and they're willing to pay the premium that comes along with that. And they can put that on their mortgage because they don't actually have the cash to go and fund all of those renovations. So those flippers have gone and made a good business. That's where they step in. They take typically dilapidated rundown houses and get them back in a livable state, putting them back on the market for somebody to live in. When you're going and taxing these businesses even more, it disincentivizes them from doing so, and it doesn't make those homes more affordable for the person who's going to actually end up buying and occupying these homes. But let's look at how many houses are actually being flipped. According to Stats Canada in BC, 3%. That's actually not a very big number. I bet most people expected it to be quite a bit more. And this is through 2018 through 2021 when the market was cooking along and there was more flippers in the market than there are right now. Interestingly enough, if you look at homes that were sold in that second year, so end of year 1 to end of year 2, that actually increases to about 6%. Now, some of those, again, could be houses that were being so-called flipped, but I'm willing to wager that the majority of those are actually people that are having to sell for more typical legitimate reasons, death, divorce, job loss, moving, etc. And they just didn't anticipate when they bought the house in the first place that they would have to move that quickly. But of course, this was a hot button issue, and politicians of all stripes and all provinces at all levels, they have in Canada focused far more on demand suppressing policies than policies that encourage supply. And I get it. I understand why. It's really easy to go and slap a tax on. It takes almost no time to pass that through legislation. And then you get to have your press release and say, look at what I'm doing for more affordable housing in Canada. I am taxing those evil investors, those house flippers, and look how much tax revenue I'm going to generate for you, the public. Of course, those tax policies almost never generate anywhere near the amount of revenue that has been projected, but it's an easy win for most politicians, whereas getting affordable housing built requires obviously not only significant investment in capital, whether it's loans, tax breaks, or actually funding the construction directly from the government, but it's also a long-term investment, probably going to be, for the most part, outside of an election cycle, and you don't get to have that press release and say, look what I'm doing. For most politicians, it ends up helping the guy that follows them after them, who gets to take all the credit for it, and they definitely don't want to do that. Which leads me to my ultimate point, and that is, you cannot tax real estate into affordability. It just doesn't go hand in hand, but unfortunately, that's the way most politicians in Canada are thinking right now. Speaking of affordability, if you want to know some of the most affordable places in Canada to buy a house right now, right here is my most recent monthly Canadian real estate market update. If you like this video, please give this video a like, and as always, thanks very much for watching.